In August 1982, the Dow Jones stood at 776 points. By the end of the decade, it had tripled. No war, no major innovation, no boom in productivity. So where did the wealth come from? That same year, the SEC quietly lifted a 40-year-old restriction on corporate stock buybacks. Almost no headlines, no press conferences. But behind that decision was the beginning of a new financial era, one where companies could legally manipulate their own stock prices without calling it manipulation. And they did. Buybacks aren't new, but until 1982 they were mostly illegal. They were considered a form of market rigging, an artificial way to pump prices, just like a gambler stacking the deck. The change didn't come from Congress. It came from a shift in regulatory interpretation, a line of code rewritten deep in the system. The justification? Companies needed safe harbor from prosecution if they were buying back shares for legitimate reasons. But no one defined what legitimate meant, and no one set a hard limit. What followed wasn't just a loophole, it was a new mechanism of corporate power, a way to funnel capital directly into the stock market without producing anything. No factory, no job, no innovation, just rising share prices. And those prices became the story. Every rally, every bubble, every historic high, underpinned not by earnings, but by buybacks. Quiet, legal, almost invisible. The average investor saw a bull market. But inside the system, something deeper was at work. A feedback loop that rewarded stagnation, penalized reinvestment, and turned the stock market into a self-consuming machine. This was not a coincidence. It was architecture. In the late 1970s, America was economically exhausted. Inflation was in the double digits. Oil prices had quadrupled in less than a decade. Confidence in the dollar was eroding, and the post-war industrial dominance of the United States was no longer guaranteed. Manufacturing was shrinking. Productivity growth was flat. And the market had been stagnant for years. Between 1966 and 1982, the Dow Jones Industrial Average moved sideways. 16 years. No real progress. Adjusted for inflation, it had actually declined by more than 70%. Investors were disillusioned. Corporate profits were under pressure, and Wall Street had lost its narrative. Then came a series of quiet but foundational changes, none louder than the ideological shift triggered by the Reagan administration. The old economic orthodoxy was dismantled almost overnight. Deregulation replaced oversight. Supply-side theory replaced Keynesian caution. And Wall Street was no longer seen as a mirror of the economy, but as its engine. This was the beginning of the shareholder value revolution. Before the 1980s, companies were judged by long-term performance, reinvestment, employee retention, product development. But a new metric took over: stock price. The market wasn't just a scoreboard, it became the purpose. One of the architects of this new logic was economist Milton Friedman. In 1970, he famously argued that the sole responsibility of a business is to increase its profits, not to its workers, not to the public, but to its shareholders. That idea, once radical, quickly became corporate gospel. In parallel, a powerful structural shift was underway: executive compensation. By the early 1980s, corporate leaders were increasingly paid not in cash, but in stock options. That changed everything, because now, when the stock went up, they got richer. Not just wealthy, generationally rich. Suddenly, buybacks weren't just financial tools, they were personal incentives. A CEO could authorize billions in share repurchases and directly benefit, often in the same quarter. But there was still one problem. Under U.S. securities law, companies manipulating their own stock risked being charged with fraud. Since 1934, the SEC had treated large-scale share repurchases as suspicious, because they were. Companies that bought back their own shares could easily create the illusion of demand, distort earnings per share, and mislead the public. So for decades, buybacks remained a legal gray zone, technically allowed, but closely scrutinized. That scrutiny ended in 1982. That year, the Securities and Exchange Commission adopted Rule 10b-18, a seemingly minor regulatory adjustment. It gave corporations a safe harbor to conduct buybacks under certain conditions. But the rule didn't restrict the total volume. It didn't require disclosure in real time, and it placed no limit on how often buybacks could occur. In effect, it told corporations, you can do this, and you won't be prosecuted. The timing was critical. Interest rates had just peaked, inflation was falling, and the markets were hungry for a new source of upward momentum. Buybacks delivered it, cleanly, predictably, silently. Throughout the 1980s, the mechanism matured. Investment banks developed entire desks to facilitate repurchases. Corporate boards approved them as routine policy. And analysts stopped asking whether a company was innovating. They started asking how many shares it was retiring. The logic was simple. Fewer shares meant higher earnings per share, even if actual profits stayed flat. It was accounting alchemy. But the market rewarded it. By the end of the decade, share buybacks had become a cornerstone of corporate finance, not to support the company, but to support the stock. And investors never asked where the demand was coming from. The answer, increasingly, was the company itself. It started slowly. In the mid-1980s, buybacks were still a marginal tool. Only a handful of major corporations used them regularly. But by the early 1990s, the logic had crystallized. Companies realized something fundamental, that boosting share prices through repurchases was not only legal, it was often more profitable than investing in their own future. Why build a new factory when you can buy your own stock, shrink the share count, and watch the market applaud? The turning point came in the late 1990s. The tech boom was already inflating asset prices, but something more subtle was unfolding beneath the surface. Buybacks were no longer a signal, they were the strategy. Companies began borrowing money, sometimes billions, not to expand, not to hire, but to repurchase their own shares. Debt became fuel, and the market didn't blink. Cisco, IBM, General Electric, tech firms, industrials, blue chips. Across the board, companies poured capital into themselves, but not into innovation, into valuation. By 2004, corporate buybacks totaled over $200 billion a year. But this was just the warm-up. In the decade that followed, the numbers became staggering. In 2007, the eve of the financial crisis, U.S. corporations spent a then-record $589 billion on buybacks. That same year, investment in long-term growth, research, equipment, workforce development, flatlined. The buyback machine had fully taken over. Then came the crash. The subprime mortgage collapse in 2008 wiped out trillions in market value. Lehman Brothers fell. AIG was bailed out. And across the board, corporations slammed the brakes. Buybacks vanished, for a moment. But not because the logic had changed, only because the credit lines froze. And here's the paradox. When the crisis hit, many of the companies who had aggressively repurchased their shares had no liquidity left. They had used their cash to inflate stock prices, not to create resilience. Some had even repurchased stock at market highs, only to see their valuations collapse months later, a kind of financial cannibalism. Example, Citigroup spent billions on buybacks between 2004 and 2007. Its share price fell by over 90% in the crisis. It needed a $45 billion bailout. Shareholders were wiped out, but executives had already cashed in their stock-based bonuses. What does that mean? It means the system didn't just fail, it functioned exactly as designed. Short-term value was extracted, long-term risk was ignored, and the fallout? Outsourced to taxpayers. After the crisis, you might expect regulations to tighten. Instead, the opposite happened. From 2010 onward, interest rates stayed near zero. Debt was cheap again, and companies resumed buybacks with even greater force. Apple, Microsoft, Exxon. By 2014, total corporate buybacks hit a new record, $680 billion. By 2018, $806 billion. In 2019, over $900 billion. The driver wasn't organic growth, it was engineering. Companies were no longer growing into their valuations. They were buying their way up the ladder. On paper, it worked. EPS rose, stock prices surged. But under the surface, productivity stagnated, wage growth slowed, investment in innovation declined. The American economy was growing, but hollow. And then in 2020, the system faced its second great stress test, the pandemic. As markets collapsed in March, buybacks evaporated. Within weeks, major firms, airlines, cruise lines, hotels, lined up for federal aid. Many had spent over 90% of their free cash flow on buybacks in the previous 5 years. They had nothing in reserve. Southwest Airlines, Delta, Carnival, Boeing, all had engaged in multi-billion-dollar repurchase programs. All needed bailouts, again. And yet, within a year, buybacks returned, stronger than ever. By 2021, the S&P 500 spent over $850 billion on repurchases. In 2022, the number approached $1 trillion. This isn't a side effect, it's the central mechanism. Buybacks drive demand, demand drives price drives narrative, and the narrative drives more buybacks. It's not a bubble by accident, it's a bubble by design. To understand how buybacks distort the system, we have to look at how they work, not in theory, but in practice. The process is deceptively simple. A company earns profit, or more often borrows cheap debt. Instead of reinvesting that money into research, new employees, or capital infrastructure, it uses it to buy its own shares on the open market. Fewer shares remain in circulation. And that's where the distortion begins. Because Wall Street doesn't reward total profit, it rewards profit per share, EPS, earnings per share. Imagine this, a company makes $1 billion. It has 1 billion shares. Its earnings per share are $1. But if it retires 200 million shares through buybacks and profits stay flat, the EPS jumps to $1.25, a 25% increase without doing anything. And markets move on EPS. Analysts upgrade the stock, index funds buy more, executives receive bonuses tied to performance, momentum builds, the stock rises. Now imagine this happens across the entire S&P 500, year after year. Between 2009 and 2023, U.S. companies spent over $10 trillion on buybacks. That number is not hypothetical, it's documented. It exceeds the GDP of most countries. It also exceeds, by a wide margin, what those same companies spent on innovation, capital investment, or employee development. And here's the twist. Much of that money wasn't profit. It was borrowed, debt recycled into equity inflation. Because interest rates were near zero, borrowing became not only easy, it became strategic. Why wait years for organic growth when you can boost your stock in a quarter? Investors didn't object, they benefited. Boards didn't resist. Their compensation was tied to the outcome. This is the buyback loop. Step 1, borrow money. Step 2, buy your own shares. Step 3, watch EPS rise. Step 4, stock price follows. Step 5, executive bonuses kick in. Repeat. Now consider the time horizon. R&D may take years to show results. Buybacks deliver in weeks. They're fast, visible, marketable. Wall Street loves velocity. Buybacks give it. But what gets lost? Capital investment, wage growth, resilience. The very things that create long-term value are sacrificed for short-term optics. The share price becomes the goal, not the result. And so the economy begins to decouple from the market. Corporate profits rise, wages do not. Stock prices surge, productivity lags. On paper, the system looks strong. Underneath, it's running on extraction. And it's legal. Rule 10b-18, passed in 1982, still governs all of this. It sets guidelines, not hard limits. Companies can buy back up to 25% of their average daily trading volume, but they're not required to report it in real time. The data often comes out months later, buried in SEC filings. No approval from shareholders, no real-time transparency, no cap on total volume. And there's no requirement that a company be profitable to conduct buybacks. It just needs access to cash or credit, which means a loss-making firm can still engage in financial engineering and appear, at least temporarily, successful. There's a term for this in systems theory, positive feedback loop. When an output reinforces its own input, the system accelerates until it collapses. In nature, that's how wildfires spread. In finance, it's how bubbles form. The more companies buy back, the higher their stocks go. The higher they go, the more pressure to continue. Stop, and the illusion fades, momentum halts, the spell breaks. And that's the vulnerability. Because if buybacks stop, whether due to regulation, recession, or rising rates, the upward force vanishes, demand evaporates, prices stall, and what remains is a market priced for perfection but built on borrowed demand. This is not a bug in the system. It is the system. The consequences of this system are not theoretical. They are everywhere, written into the architecture of modern capitalism. Not in headlines, but in line items. Not in scandals, but in silence. Start with wages. Between 1979 and today, U.S. worker productivity rose over 60%. Yet hourly compensation barely moved. The connection between work and reward, once direct, has broken. And while economists argue over causes, the capital flow tells its own story. Trillions to shareholders, stagnation for employees. In 1982, CEOs earned roughly 30 times more than the average worker. Today, that ratio exceeds 300 to 1. This isn't just inflation or ambition. It's the result of a system where corporate leaders are paid in stock and judged by its price. Every buyback increases their payout. Every quarter is a referendum on share performance. Not strategy, not sustainability, just price. Now look at capital investment. In the 1960s, U.S. companies reinvested nearly 50 cents of every profit dollar into long-term growth. New equipment, new facilities, research. Today, that number is often below 10 cents. Not because opportunities vanished, but because the incentive shifted. Reinvestment delays gratification. Buybacks deliver it instantly. So companies strip mine their balance sheets. Even firms that dominate global markets, firms with world-class technology and global talent, often choose to shrink rather than build. They reward shareholders not with growth, but with scarcity. Fewer shares, higher EPS, higher stock. Repeat. What does this mean for resilience? In a crisis, these firms collapse faster, not from competition, from exposure. They've spent years draining their buffers, buying their own stock instead of fortifying operations. When shock hits, they need bailouts. 2020 proved it. From airlines to energy giants, many of the firms that lined up for pandemic-era stimulus had spent the previous decade executing massive buybacks. They had no savings, no cushion, no room to maneuver. The public paid the bill, again. But the distortion goes deeper, into the market itself. Buybacks now make up the largest single source of demand for U.S. equities. Not pensions, not foreign investors, not mutual funds. Corporate America is the market's own buyer. It's a feedback loop where the seller and the buyer are the same entity. This doesn't just inflate prices, it warps valuation. A company's share price no longer reflects future cash flow, competitive advantage, or market strength. It reflects the volume of its own repurchases. Fundamentals still exist, but they've become decorative. Narrative has replaced analysis. And the result? Volatility. Because when markets depend on buybacks for upward momentum, any disruption, higher interest rates, regulatory pressure, public scrutiny, becomes a systemic risk, not just to one company, but to the market's entire gravitational force. In 2018, when corporate tax cuts triggered a record $806 billion in buybacks, the S&P surged. In 2020, when buybacks froze during COVID, markets panicked. In 2022, as interest rates rose, buybacks slowed, and equities stumbled. This is no longer investor-driven capitalism. It is self-referential finance. It rewards extraction, penalizes depth, and leaves the economy more fragile with each cycle. Every repurchase is a bet that the stock will go higher, without necessarily earning it. When that bet fails, it fails publicly, violently, and across portfolios. The system doesn't implode all at once. It erodes from the inside. And when the facade breaks, everyone sees the same thing, a market rich in price, but poor in substance. Then it was called financial engineering. Today, it's called returning value to shareholders. The language changed, the mechanism didn't. Let's take 2023. Interest rates were rising. Inflation was persistent. Economic uncertainty loomed. But one number stood out. U.S. corporations still executed over $1 trillion in stock buybacks, the highest in history. Not because the economy was thriving, because the market demanded it. Companies like Apple, Alphabet, and Meta announced tens of billions in repurchases, even while laying off tens of thousands of workers, freezing hiring, and warning of slower growth. In the same breath, contraction on the ground, expansion in the market. This isn't contradiction, it's design. Modern buybacks aren't merely tools of capital allocation, they are instruments of narrative control. When fundamentals weaken, repurchases create the illusion of strength. When growth stalls, buybacks accelerate to maintain EPS targets. The illusion is disciplined. It's quarterly. It's expected. Wall Street analysts often penalize firms that don't buy back shares, even if they're investing in real innovation. The market has internalized buybacks as a sign of financial health, even when they're funded by debt, even when they cannibalize the balance sheet. And here's the deeper twist. The very institutions warning of fragility, pension funds, investment banks, asset managers, are also beneficiaries. They depend on the price stability that buybacks create. Everyone is inside the same structure. Even the Federal Reserve, indirectly, plays a role. Years of ultra-low interest rates created the conditions that made debt-fueled buybacks not only feasible, but optimal. Companies weren't irrational. They were following the most profitable path within the rules. Rules, of course, written by regulators. Rule 10b-18 remains untouched. No mandatory real-time disclosure, no cap on total volume, no restrictions on timing, meaning companies can repurchase shares while executives are selling them, which they do. A 2021 SEC report found that executives often sell large portions of stock shortly after buyback announcements. The pattern is consistent. Shares go up, they cash out. Legally, systematically, without oversight. This isn't a failure of ethics, it's a success of structure, and the broader economy reflects it. Since 2009, US GDP has grown at a modest average of 2%. Corporate profits have soared, but the gains have concentrated. The top 10% of households now own over 89% of all US equities. The top 1% owns more than half. Buybacks have helped drive one of the most aggressive upward transfers of wealth in modern economic history, invisibly. Because the average worker doesn't see a buyback. They see stagnant wages, fewer benefits, less job security. But the index keeps rising. The news calls it a bull market. Politicians call it recovery. But the core remains hollow. And that brings us here, to the present, where companies no longer innovate to lead, but to survive inside the system they've helped create. Where executives are trained not in operational leadership, but in capital allocation. Where success is defined not by what a company builds, but by how efficiently it can buy itself. The stock market has become the economy's most elaborate mirror, and behind it, the reflection is growing thin. Because when a system rewards short-term performance over long-term resilience, it eventually runs out of ground. And that moment, when the buybacks slow, when rates rise, when liquidity fades, reveals not just a downturn, but a reckoning. The structure that created so much value is also the one that made it so fragile. History didn't change, only the labels did. The market never asks why the price is rising, only how long it will continue. That's the quiet power of stock buybacks. They turn the question upside down, from value to velocity, from foundation to feedback. Since 1982, every major market bubble, from dot-com to housing, from pandemic rallies to tech surges, has carried the same hidden current. Not just speculation, not just leverage, but self-reinforcing demand created by the companies themselves. When we look back, the pattern is clear. First the policy, then the mechanism, then the illusion, and finally, the silence before the break. Because in the end, buybacks don't prevent collapse. They delay recognition. They smooth the surface while the floor weakens. And when the break comes, the surprise is never the fall, but how long the illusion held. Some systems fail loudly. Others fail by design. History doesn't repeat. It waits for us to believe again.